In this jam-packed week for markets, what will actually move the needle and what should investors be watching? Joining me now to break it all down is Kevin Gordon, head of macro research and strategy at Charles Schwab. Kevin, great to have you at the desk.
Nice
Thanks so
to
much
see
for being
you.
here.
Thanks for having me.
Good to see you as well. So we obviously have quite a bit on tap this week. We have tech earnings, we have the Fed decision, we have PPI, a lot of cross currents here. What's actually going to move the market this week?
So what has been moving it a bit in terms of some of the sector leadership shifts has actually been earnings, because the beat rate has come down a little bit. You've actually seen, on average, companies that even beat on earnings, they've actually been getting punished by the market, meaning their share prices haven't been rising in response to it. So it's been a little bit more of a restrictive market in terms of expectations just being for not only good earnings, not only good revenue, but also solid guidance. So I think that is something to keep in mind, especially with tech, because what we've noticed over the past few quarters is that there has been more of this kind of brake check when it comes to the hyperscalers and what they're anticipating for CapEx spend, everything AI related. That's what's kind of sparked the past couple of corrections for the tech sector. So I think that is probably key to watch within earnings. But of course, the Fed is central to this, not only because of what happens in the press conference for when Powell speaks, but I think if we get any kind of Fed chair announcement this week from the president.
Okay, so let's break both down, but let's stick with tech for just a second, because would you say that the bar is lower, though, given the fact that the Mag 7, we'll hear from 4 of the Mag 7 this week, haven't really been all that magnificent?
Yeah, no, in terms of performance, over the past 5 to 6 months, they've definitely taken a step back. But I don't think that necessarily provides an excuse for still what investors expect in terms of the return on investment from a lot of the spend that has already happened. So there are still relatively elevated expectations, even from a multiple standpoint. There has been considerable multiple expansion for just that group. So to be able to grow into that and ultimately alleviate some of that multiple pressure, I think that's still going to be a focus for tech.
But if they disappoint, what happens to the broader market? Is this a market that we've been seeing this rotation out of big tech anyway,
Absolutely.
But is it vulnerable?
Well, what's interesting is that even though there's been some pressure on the indexes, you've seen, sort of the slow grind higher for an index like the S&P 500, breadth has actually been relatively solid. So you've got almost 70% of names in the S&P that are trading above their 200-day moving average. It doesn't necessarily feel that way because of how slow the gains have been over the past several months, but that's because of what you mentioned with this rotation. That's sort of the nature of it and the math of it. Mm-hmm. You take consumer discretionary, communication services, and tech, those 3 sectors make up 55% of the S&P 500. So if those are not leading and you have the rest of the market still doing well, you're just not going to get as strong of a gain at the index level. So it just kind of comes down to the index math and how that all adds up. So tech can certainly pull back and the rest of the market can do fine, but that wouldn't necessarily yield you the best result at the index level.
Does earnings season change that? Does tech regain its dominance after this earnings season?
I do think from a sentiment standpoint and a flows standpoint, you have seen a little bit more of a pullback in that sector. So to the extent you want to be a little bit of a contrarian and see maybe some upside for tech, if for some reason some of the hyperscalers or the sector broadly, if they do surprise to the upside, margins continue to expand, if there is solid revenue and earnings guidance moving forward for the rest of the year, I think there is some room for that to have a little bit of a shift. But the rotation has been strong enough over the past 6 months that I think you would need to see a more material shift over several weeks, not just one day after one company reports, for instance. So I think beyond this week and the results that we get from 4 of the Mag 7, I think you would need to see more consistency in that outperformance for the trend to completely shift.
So what is your market view so far in 2026? And as you think, it's hard to already think about year end when we just started, but are you bullish this year?
Yeah, we're constructive on the fact that the market can do well from point A to point B, point A being the beginning of the year, point B being the end of the year. But I think in keeping with what has happened with this shift in leadership, it's just paring back expectations for the kinds of gains that you could see at the index level. So, really stellar double-digit gains, if you're not having the mega cap dominated sectors participate in that to the degree that they have been, you're just, again, the index math is just not your friend as much that way. But that doesn't mean it doesn't pave the way for other sectors to do well. So this recent leadership that you've been seeing from energy or from materials or even parts of industrials or even healthcare to some extent, that's great. And it is consistent with the fact that the majority of the market's been doing relatively well, but they're just not the biggest components of the overall S&P 500.
What about the Sell America trade that we've been hearing about? Are you actually seeing real signs that people are sick of paying a U.S. premium, or is that just sort of
No, not
headline?
yet. There's 2 ways to look at it. You can look at it, day by day, and you can look at some of the downward pressure for the dollar and the pressure that's been under. And if you look at something, like the Bloomberg Dollar Index, that has weakened to its lowest since March of 2022. So there has been more of a breakdown there. However, you also have to look at that and measure it against what is some of the still really strong flow data into the U.S. from foreigners. So foreign purchases of stocks, foreign purchases of bonds, that's still been relatively elevated. We haven't seen that, materially weaken at all. So I think those are the data sets, which unfortunately are pretty lagged, but the data that we have so far, those are the series that you have to look at to see if the wholesale America trade is really gaining traction. So far, I would argue there's a relatively healthy split between the dollar, remaining under some pressure, but the overall sort of stock of what foreigners own in the U.S. not necessarily, being touched at all.
Do you think that there's more upside potential internationally or here in the U.S.?
We've been constructive on international for the past few years. For the first couple of years of that, it was a little bit of a pain for us because it wasn't working as well. But I do think that if you just look at the dollar itself, you look at how much of a contributor that was to ex-US gains last year, to assume that you sort of get another year where the dollar doesn't strengthen considerably, which we don't think is necessarily the case. I do think that continues to help for countries outside of the U.S. And stocks outside of the U.S. But I think the important thing, as we're seeing with some of these blips in outperformance for tech in the most recent days, rotation trades never happen in a linear fashion. So it's not as if small caps, for example, in the U.S. are going to continue to outperform like they had been for 14 or 15 straight days relative to the S&P 500. Very much the same case with international stocks too.
So what's your best investment advice for those regular investors sitting out there saying, what do I do now? I had a great 2025. I'm hearing that mega cap tech might not be dominant in 2026. It's not.
Yeah.
What do I do now?
Well, I mean, every investor is different. We've got millions at Schwab in terms of clients. I think from an overall standpoint of what your portfolio looks like, if you haven't been engaging in rebalancing, not necessarily based on the calendar, but maybe a little bit more based on volatility, letting your portfolio tell you when it's time to make a move. If you've got really sharp exposure that has increased over time to tech, for example, or vice versa for something like energy, if you've been underexposed because of how poorly that sector has done. Sort of a clear example of how you can maybe rebalance to get those back into gear a little bit. So it's kind of a reminder around, number one, the power of diversification, but number two, how you can take advantage of some of these volatility swings to do that, because we are still in this pretty tense environment when it comes to geopolitics, but also domestic politics that to some extent do drive markets from day to day. So to the extent you can take advantage of some of those swings and add to that rebalancing effort, we think that makes a lot of sense.
What I'm hearing from you is you're pretty optimistic. We just maybe have to level set what those returns might look like this year if tech isn't dominating. Not hearing a lot of protect on the downside or hedging risk. How should investors be thinking about that?
Yeah, I mean, I think it makes sense, especially because of how unique this cycle has been. So if you just look at labor, for example, we've just gotten some fresh data this morning from the Conference Board in terms of the consumer outlook worsening again for the labor market. This big expectation that you're going to continue to see a deterioration. What we've seen over the past almost 3 years now has been this slower grind higher in the unemployment rate, this slower grind higher in the number of consumers who are saying, hey, it's pretty tough to get a job out there. That's not typical of what you see in a slowdown or in a recession. Typically, it's a pretty straight line up and move up for the unemployment rate, and then you kind of grind low over time. I say that because we've been in this environment over the past several years where the market has had to confront what parts of the economy are in a recession and what parts are not. Not a very typical spot to be relative to history. So that, I think, is something to keep in mind as we continue to sort of grind through this and see some of these shifts in leadership. We're not necessarily seeing signs that the market's pricing in a recession. That's largely been consistent with what the economic data have told us. Manufacturing, definitely survey-based data are in recession, but services and the hard data are not. So that split remains, probably continues in the first half of the year. And I think that's important to keep in mind when you're thinking about trying to hedge against some of the weakness in the economy that might show up.
Okay, let's bring it back to the Fed to wrap things up. I think 97% chance that the Fed will stay on hold tomorrow. It really looks like the market's not anticipating another rate cut until June. So it seems like that might be priced in at this point. But is this a true pause? Is this just sticky inflation that's causing the Fed to have to pause? And what does this market want?
Well, I think consistent with what you just mentioned with market odds and pricing, I think the market sort of wants a hold in the sense that it's expecting one. So, the Fed really doesn't go against market expectations often. So I think that probably, it's not the only reason that they'll hold. I think there's reasons, as you just mentioned around sticky inflation that they do hold. But when you combine the recent downtick in the unemployment rate, the fact that jobless claims have remained low, the fact that we did see a little bit of a rolling over in job cut announcements, that the labor market is still in an uncomfortable position of low hiring and low firing, but importantly for the Fed, relatively low firing, the layoff rate being very, very low. I think that in combination with the fact that inflation is averaging closer to 3% than 2%, you put that all in the blender and that gets you a hold and probably a pause. I think it probably makes sense until the summer. I'm always, skeptical and wary of looking out more than a couple months for the Fed because
changes so much.
you just
We've
never
seen
know
it happen,
what's going to
yeah.
happen. So I think that you have to keep in mind a lot of the volatility that we could get until the summer. But if you were to extrapolate conditions right now into the summer, yeah, you probably don't get a cut for a while.
Okay. So just final one-liner about what investors should be doing right now.
I'd say stay disciplined around diversification, especially because, and I know it sounds like a boring answer, but especially because of a lot of the volatility we've seen on the geopolitical scale and what that has done to areas outside of what we think of as traditional asset classes like precious metals. Staying diversified in this environment is the best guard that you have against that.
All right, we'll leave it there. Kevin, always appreciate
So
you
good to
joining
see
us.
you.
Thanks so much.
Thanks.
That's Kevin Gordon, head of macro research and strategy, Charles Schwab.